there is a systematic and a disciplined way in which your wealth can compound. We're of course talking about mutual funds. ET now has been a huge champion of the mutual fund cause. We have our flagship initiative, Jan Nivesh, an investor education and outreach movement urging citizens to pledge at least 1 day's income a month in mutual funds. More than 1 million has signed up for the pledge, and that's created a record of sorts. The mutual fund industry in India in the last decade has seen lakhs of new investors getting added every year on the back of more awareness and the ease of investing. So what else can we do to unlock the potential going forward? To discuss all of this and more, we have mutual fund industry, engines of India's equity cult, brought to you by SBI Mutual Fund. Ladies and gentlemen, a big round of applause as we welcome on stage Navneet Munot, CIO SBI Mutual Fund, A. Balasubramaniam, MD and CEO at Aditya Birla Sun Life AMC, Sunil Subramaniam, CEO Sundaram Mutual Fund, Ashutosh Bishnoi, MD and CEO Mahindra Mutual Fund, Prabhat Avasti, the Managing Director of Nomura, and Kalpen Parekh, President DSP Mutual Fund. This discussion will be moderated by my colleague Aisha Farid.
Start of the year, I would have started this panel. I would have said, how's the Josh? And you would have said, hi, sir, or hi, ma'am. Is it the same Josh, the same level of optimism when it comes to equity markets?
In the market, for sure. While there is a bit of disconnect between what we are seeing in the economic data and what we are seeing in the market, which is not illogical because markets are forward-looking. We're also part of a global reflation trade. Globally, central banks have printed so much of money fearing a recession, while the overall economic data has been reasonably okay, which is like a very happy situation for most of the equity markets globally. India has also benefited. We have got positive flows. Markets are also enthused that given all the recent steps that have been taken by the government and most of the other reforms over the last few years, next couple of years, earning growth should normalize. Last 5 or 7 years have been a complete, I would say, a big disappointment on the earnings growth side. That should normalize over the next few years. And I must mention this, that given the gravity of situation in terms of growth and all cylinders of growth, consumption, investments, exports, I'm sure we'll have to do a lot more. There's a lot that has been done. Finance Minister earlier listed several of them, but I think there is a lot more that we need to do over the next several months, and I'm sure markets are going to keep a very close eye on all of those steps.
But Bala, let me come to you. Paper, yes, everything is okay. But if I just bring up the last month's AMFI data, besides the retail inflows, the data is not seeming all that great. What's keeping investors at bay? Is it just the sentiment? Is it just the lack of animal spirits? Because if I look at other asset classes, be it fixed income, be it real estate, or for that matter gold, none of it is working. Then what are people doing? Are they just sitting on cash?
I think the function of, if you look at last 6-7 years, then we had one of the highest growth, both in terms of AUM as well as customer addition. The number of new customers who have come in the last 4 years is one of the highest, especially post 2014. And post demand, I think further improvement that happened on customer additions. And if you look at the market return, leave aside Nifty or maybe Sensex, I think money has come in the rest of the market, and one has to of course look at how the schemes have performed, how the equity markets have performed the last, not just only 1 year, look at say 3-year period. That's a function the way it always happens. For every market starts with one good period, then it followed the one bad period, again a good period. If you look at the 10 years return, has been good, but if you look at a 5-year return, is pretty decent. But if you look at 3-year return, could be weak. If you look at a 1-year return, is good. I think we go through that cycles.
Did you say 1 year good?
Yeah, 1 year of course is not that bad. So 1 year is still positive actually. If I look at the same 1-year return, roughly about say 6 months back would be negative, would have been negative. I think that again, investors see it and then say, okay, now I've come actually the last 1 year, what is my experience, 2 years, what is my experience? And especially in SIP, especially in this kind of period, normally in a one trended upward cycles, of course SIP does give superlative return. At the same time, the market goes through ups and downs, it gives of course a moderate return. I think it's a function of that. And second is, I think as Navneet mentioned about it, but everything is driven by hopes and optimisms and also the sentiment. And whatever certain in the last 1 year has been one of the toughest years. Though many people did not did not understand the impact of the ILFS crisis in the financial market, and people took some time to understand, including the regulators, including the policymakers, did not actually pay much attention to the potential impact the fall of ILFS would have in the financial service industries. Nobody expected that. I think this kept on actually moving on from one to other and just came, even today also we are still struggling with fixing some of the issues. And there is a fallout of that. The fallout, of course, is the comments in the economic growth slowdown, and there is a fallout in terms of confidence being low, and the fallout is actually on the basis of the confidence in terms of lending to each other has also been relatively low compared to what we have seen in the past. So that something is also ultimately has to somewhere result in growth and then subsequent the market and so on and so forth. And again, the broad market, I think always the surprise is there, the broad market does well. And the broad market is a function of the money flow that's coming, as well as Navneet mentioned about the recent past, the government has started addressing some of the issues in the form of tax cuts and many other things. So therefore, it is now building up some kind of, not animal spirit, so to speak, but at least some bit of optimism coming back. I think we are at a stage where optimism is coming back, and probably it's followed up with some bit of pickup happens in the rural economy, thanks to the good monsoon. And then the budget, ensuing budget that is there, it starts pushing up some of the supply, demand side, the issue that they have to address it, the form of picking up the demand that through some kind of tax cut and other things, then we'll probably get into the animal split. I think the function of, generally my belief is every 2 years of bull market should follow with about 18 months of, or 2 years of bear market or maybe flat market, again, so on like that cycle. And in the mutual fund industry, the biggest thing that we have seen in the last so many number of years being in the industry is at every point of time we start looking at silver lining, and at every issues followed with one silver lining. And what we believe that I think is today the silver lining is there in the form of the lowest interest rate that's possible, which I think would make investors think about now let me come back to equity, let me come back to fixed income, let me come back to other asset classes because interest rates are low.
Sunil, how important is it for a mutual fund investor to stay put, to ride the cycle of a bull and a bear market, keep the time horizon long? I know, these are things that we talk about day in and day out. It's easier said than done. But like Bala was saying, if you were to draw up a comparison of the market return or the mutual fund industry return in the last 10 years to 5 years to 1 year, the difference is staggering. The importance of just staying put, being patient, investing is the most boring thing to do, as opposed to trading, perhaps. That's where the thrill and the excitement is. Emphasize for our viewers, I don't know how many of us really are equity investors. If I ask anyone to raise their hands, maybe only 20% of the population would raise their hands, even in this hall here. The importance of just being patient and staying and keeping at it.
I think one of the key things in India is that we don't have a social security net for our investors or for our people. So people have to build for their own inflation beating return. And I think the people have to simply keep in mind that inflation, the only asset guaranteed to beat inflation over the long term is equity, for the simple reason that demand and supply leads to inflation, right? So your suppliers are the ones who are listed in the stock market. So when inflation is rising, that profit is actually passing to the suppliers who are the ones listed. So the easiest way to make people understand that you face inflation, onion prices rises, you start rona dhuna. The easiest way to explain to people to say that ultimately there's somebody who produces. I mean, onion is like a agri commodity, but anything else, a manufacturing company or a service company has to deliver that. And that inflation which you are suffering as a customer is straight away going to some corporate, and the equity market is giving the value of that. And like when Bala was mentioning, you take a 15-year track record, the earnings growth of the economy, right? Nominal GDP growth has been around 12 to 15%. The EPS growth of the stock market has been 13%, and the stock market has done 14%. So the longer term, equity is the only asset guaranteed. And like you said, boring investment, the best way, because I think SIP as a concept, I think if people looked at SIPs as a savings EMI, I mean, for everything, for a drop, for a credit card payment to buying a house, you think of an EMI. But if you simply adopt a tactic that every month from my income, I first decide what I save, and then only I go to spending, right? That's one. Second, think of that as an EMI which you can't alter. You fix that up, and I would suggest the third thing is everybody goes through increments and increase in salaries. Every 3 years, you just increase your SIP by 50%. You're guaranteed to be a crorepati in 15 years, right? So I'm just saying that, so for people to think about it, it's just a very simple equation that all my mehengai impact, somebody is enjoying. Equity markets is the simple route for me to partake of that enjoyment. And to do it systematically means two things. One, you are making sure that your income comes monthly, your savings goes monthly. So while they say about rupee cost averaging, power of compounding, leaving all that aside, when you're getting your money in monthly, best to save it monthly. And in the process, what you achieve is all the intermittent volatility actually gets you more units, right? And that's the simple cost of rupee cost averaging.
Ashutosh, at an average of $2,000 per capita income in the Indian households, why is it that only a minuscule amount of that household income finds its way to equities, and within equities also not direct equities but SIPs?
Good question, actually. If you think about it, there has been such a obsession in India with real assets. And not surprising, we've lived through centuries of, let's say, not necessarily being well off as a nation, as a population, and therefore physical assets is something you feel, you touch. Clearly, for example, gold has been a very high obsession with India, largest buyers of gold in the world. We continue to be, we produce nothing. But if you think about this, that's a kind of a historical perspective. But if you think about going forward, we started this business thinking we are joining the party late. We are like 44th player in this game. Why did we do this? Because there is something that's happened globally which we believe must happen in India. It has got to happen. The capital is lying in the real assets. If you just take gold, between the Indian Homes and Indian Temple Trust, we own 27,000 tons of gold, the largest owners of gold in the world. Put a rough number to that, it's about what, $1.5 trillion worth? We talk about creating infrastructure for India in $1.5 trillion. That's lying in people's homes, a dead asset. So clearly, we think that capital has to come to the capital market from homes. This is exactly what's happened everywhere in the world. If you take the bigger markets, take the US, take Europe, take UK, take Japan, not China yet, these are markets where more than 50 to 60% of homes are contributing their savings via the fund into the capital market. It's via the open-ended funds because they feel they take care of them. They take care of the administration and governance of companies where they invest. So there's a confidence built in people's mind over periods of time, over decades, that this is the right way to contribute capital and, like Sunil said, to take care of my personal inflation target. But the nation creates capital. We believe that that's got to happen in India. The journey is just begun, and I must say, sitting on this panel, there are at least 2-3 people, including Bala, who led the campaign of mutual funds here, getting people to understand that they don't have to stay parked in physical assets. That's where the asset is doing nothing. It's not earning anything. If you take rental yields in India for all the land we own, do you know that on an average household level in rural India, 156 million households own 0.73 hectares of land each on an average. Most of it does nothing for them. It's not even cultivable. We have to be able to get out there and take a message to people that you must convert this into financial asset. And the way to do this is pretty much what's happened rest of the world. Buy yourself a good mutual fund over a long period of time. You make wealth, capital comes to people who need the capital. So according to me, that's the way forward. Will it happen? Yes, messaging is important, and I think we are doing a lot about messaging. What's stopping? At our company, we find that being able to go and sit next to a customer, to explain to him that, look, this is what you got to do. This is the risk you'll have to take. A lot of people tell me that, you're starting a company, you're saying you're going to sell mutual funds in small markets, in rural markets. Do people understand risk there? And I put it to you that nobody understands risk better than the farmer. He takes a risk every time he gets out of his house. He doesn't know whether it's going to rain. He doesn't know when it will rain. He doesn't know whether he's going to have his seed popping or there will be a drought or whether there will be some kind of invasion by locust. When he finishes taking the crop and he goes to the mandi, he doesn't know what price he's going to get. That guy knows how to take a risk. He takes a risk every day. We just have to explain the risk to him in his language. If we do this, there is a lot of capital to come via mutual funds into this business.
Kalpen, is that the biggest roadblock? Is it the psychology? Is the risk-averse nature of the Indian, which is keeping the potential of the mutual fund industry at bay?
Partly yes, because investors don't necessarily think as rationally and cold-bloodedly as money managers who preach to them that you should come and invest. And obviously they have their own lives and they're busy with that. So for us to expect that they will wear our hat and think rationally is unfair. And which is why we see money coming only in upcycles. Had the mutual fund Sahiye campaign not coincided with the rise in markets between 2014 to 17-18, the outcome may have been a bit different. What we need to continue to build up on the good work that the industry has started in the last many years, compliments to you guys also for the campaign that you are running, is simplify the messaging. And the messaging has to be candid, honest, and a two-way messaging, and not a one-way messaging only showing upside. If the wiring to the investor is that every time you invest, you'll make money, and then he says that, okay, in FD I was making 7%, but now in SIPs I'm making only 3%, he feels let down. So one is the education. Now, education is not easy. We all know education is boring. So how do we bring simplicity in messaging, entertaining and engaging way of educating is one way to solve for this, number one. Number two, I feel more confident today than ever before. While volatility will continue, there may be years perhaps when monthly flows could be negative like last month. How do we need to prepare for it is primarily by creating pipelines to reach consumers. And that process has started in a very systematic manner in the last 2 years with emergence of lot of digital platforms. There are many unknown digital platforms today who in a month are acquiring 20,000 SIPs per month. The transformation is structural, that as consumers we need to invest. There will be periods of cycles, but two things that the industry needs is constantly build distribution. The reach to reach customers, number one. And number two, when that reach is being built, parallelly build up on authentic, simple, and entertaining messages to make consumers realize that what is investing all about. Our industry needs to move away from obsession of only equity funds, but look at multi-asset products which have equity, fixed income, gold, and we manage all these asset classes. Mutual fund is not only equity. So if we are able to do these 3-4 things together, the journey can be less volatile and less cyclical for the industry, and the investors will be more mature.
Navneet, at 8 lakh crore rupees of SIPs, what will it take for the figure to double?
Think about it, we are going to be 5 trillion, a year, whatever, a year or two here and there. At $5 trillion, do the reverse calculation, 35% of investments. Then what is the savings need? How much of that you can borrow from foreigners, right? I mean, we already have, if you look at our overall savings from foreigners versus domestic, there's already a large gap. You cannot continue that. We are not a structural current account surplus, whatever country. Over a period of time, I think we need to take this amount substantially higher. At 1 lakh crore is almost the same as the divestment target of the government. Where is the savings left for the private sector? The total financial savings in the country is around 8 or 9% of GDP, which is the borrowing by central government plus state government plus most of the PSUs. Where is the savings left for the private sector? We have severe shortage of risk capital. Every single regulation, every single policy that we are framing, we must keep in mind that we have a severe shortage of risk capital. And what do we do to get more risk capital into the economy, which is very, very critical. For this $5 trillion economy, I strongly believe that, as SPM has said, that there are only two classes of people. People who are poor, people who want to help poor. And I think our industry, mutual fund industry, hasn't thought on those terms that we can play a very significant role in reaching that 5 and also ensuring that growth is sustainable and equitable. That growth is distributed among large number of people because in a democratic setup, if growth is not equitable, it creates another several challenges. And I think if we focus on most of the other challenges in the economy, so whether it's climate change, whether it's inequality, whether it's lack of innovation, which is a serious problem with India, which is the reason why our exports are not going up and we have several other challenges. In all of those issues, our industry can play a very, very significant role in terms of the way we allocate capital, number one, and the way we engage with businesses. And I think if we do that, there is a reason to believe that we will create an asset management industry which could be world class.
Absolutely. You got to tap the potential outside the metro cities. What would it take for mutual funds like you to really go to the grassroots level and urge them to invest into mutual funds?
This is where I think the way I think the industry went about approaching the expansion as a strategy. I think thanks to SEBI, as well as thanks to the members of the AMFI, who jointly actually came with the theme called B15 and T15. And today B15 has gone to B30. The moment you actually put a set a target that you need to go beyond 30 cities, then naturally every player in the industry starts going and actually is making the effort to build the market. I think one of the bigger things which I think you mentioned about mutual funds say is not about what messaging you are giving, is about actually making a feeling that you must go to those markets and start expanding, create an awareness, and so on and so forth. And believe me, the last few years, what you've done is only scratching the surface. As we move forward, I think there is a clear mandate that has been given by the regulator that the 2 basis points of industry education money has to be spent only on educating investors. That is, believe me, even the one which you run on your channel, which is the Johnny Wage, is more targeting towards getting every customer actually to own mutual fund industry. And compare that with any other classes where any rural investors are putting money is only in the real estate. And if you look at the power of compounding there, vis-a-vis the power of compounding here, and combined with the liquidity that is being offered in the mutual funds, I think people will start understanding that.
Crores of people have joined mutual fund indirectly through the pension funds. So almost like, I guess, more than $15 billion have come into equity in last 3 or 4 years. And there are millions of those subscribers of Provident Fund who've got exposure to equity indirectly. So we look at the folios in the mutual fund industry. If you add that, then the growth numbers are slightly different.
So the Josh remains high. Hopes at least remain high. But we're going to wind up this discussion on that note. Thank you all so much for taking the time out and speaking in.